Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today, Mena and I would like to talk about capital allocation, and that's probably just a fancy way of saying what are you going to do with your profit. I'm really interested to learn that there's a lot of European businesses and many that are very large businesses that are listed that are still family owned, not majority family owned, of course they're listed, but the founding family still has, quite a large share, and this is particularly common in Germany. And you might be feeling like that's a really random story, Stuart, to kick off a podcast. But the observation is that a lot of these businesses, as I said, they're very large businesses, often multinational businesses that have survived many generations in a family. So it started a long time ago. And one of the reasons that they were started is that a lot of these businesses don't carry debt within the business. And so when you look at comparable businesses in comparable industries in other geographical markets, a lot of those listed companies will carry debt. And an argument can be made that, it's a more efficient sort of capital structure within a business. The other thing is that they've always held a lot of cash on balance sheet. Now, this is a generalization, of course, but it's something that we can kind of learn from because it means that they've survived lots of challenging times, a couple of wars, for instance, and by having no debt and a lot of cash on the balance sheet means you have a very, very strong business that can weather many storms. So that's what we want to talk about today is what do you do with your cash? How do you allocate your capital? And how can you do that in a way that, isn't going to put your business at risk?
So what I typically advise clients to do is basically to split your capital allocation or your profit that's available to you in six sort of categories. Now, the first is the owner wage. So how much of a wage are you drawing from the business for, not obviously to just remunerate yourself for your efforts, but for a tax perspective too, what makes sense for you to actually draw from your business. Now, the second category is obviously tax. Now, this is probably one of the biggest cash outlays from any sort of business. So what are you provisioning for tax? How much are you setting aside? Is it the 30% plus your GST component? Do you include your PAYG, your superannuation, your payroll tax and so forth? And how is that accounted for? Is that going to a separate account or it's sort of set and forget? Or is it invested in sort of defensive assets such as a bond or a term deposit and sort of released as needed? And then what contingency is the third item that you have? So what buffer do you have in your business to weather the storms that Stuart was mentioning before? The next bucket is to basically understand what reinvestment do you need within your business. So what buffers do you need to actually reinvest in sort of equipment, materials? What if you're in a cyclical business, what do you do in your downtime to reinvest or have your staff do to reinvest in the business? The next bucket is the external investing. How much do you want to withdraw from your business to basically invest externally? So you're basically not all your eggs are in one basket. You're diversifying away from your main business. What is allocated to that? And then finally, and the most one that most people are inclined to sort of focus on is lifestyle. How much of my business profits can I actually use to fund my personal lifestyle? Now, if it's not written down, it's emotional. And time again, I see clients just see a healthy bank account balance. Okay, let's rip out $100,000 or let's rip out $1 million with no foresight as to what's actually involved in the business. What are we going to have to do in 6 months' time? We might have a large machinery breakdown, for example, and we've got no contingency in place. Or one of our machines, for example, might be redundant in a few months. What's it going to cost us to actually invest or improve that particular machinery? So it's really important to understand your numbers and have it all written down and have a methodology around how you break down your capital allocations.
Okay, let's talk about some of the sort of structural landmines we kind of need to navigate. And one we've spoken about, we've done a few episodes on it, in fact, is Div 7A loans. Div 7A loans arise when a business is operated in a company and the owners or the shareholders of that company take money from that company without paying a dividend or through salary. And at the end of the day, the ATO says, well, that's really a loan and the company should be able to charge you interest. And of course, that interest attracts more tax liabilities. Timing of distributions is also something to really think about. We pay living expenses ongoing, weekly, monthly, so on and so forth. So if you're only going to take distributions annually, you need to think about how you're going to kind of bridge that gap. But maybe you're better off actually taking distributions weekly or fortnightly or monthly more often. But how are you going to work that out? How are you going to make sure that you're taking from current year or current period profit as opposed to past period profit? If we've got a corporate structure, company that is, and we're going to pay out dividends, do we have enough liquidity to do that? Do we have enough franking credits to do that? So in some circumstances, we will actually prepay tax installments so that we have franking credits to pay out dividends in a particular year. This is more relevant for newer businesses rather than businesses that have been around for some time. And if it's through a trust, do you end up with unpaid present entitlements, and how are you going to deal with that particular issue, which is pretty complex at the moment, given there's a court case that the ATO is pursuing. But essentially what you want to do is make sure that your structure aligns with the way that you want to use your capital or distribute your profit, whether that's for living expenses or for any of the matters that Mena previously spoke about. So, for example, we have a client in the aviation business. One of their entities is the entity that owns the aircraft. Of course, the aircraft are expensive, so they have to go out and buy this expensive aircraft. They depreciate that aircraft in that entity, and they pay rent to utilize that aircraft into a related entity. The problem, though, is it was set up as a company, and because the depreciation deductions are more substantial, that entity was recording losses. And now it has surplus cash in that entity, but very low retained earnings because of the depreciation deductions, which means that we can't get the money out of the entity. It's the wrong entity, the wrong structure. So it's really about understanding the cash flow of a business and then also marrying that up to the entity and how that behaves to make sure that we're able to utilize that cash flow in a very tax effective and business effective manner rather than being that cash being trapped in a particular entity, like, for example, that client. Which is a perfect segue, Mena, because it's not all just about minimizing tax, is it? It's one element, but there's many other elements we need to consider.
And frustratingly, that's what a lot of accountants focus on, just tax. We've inherited countless amounts of company accounts from very reputable, large accounting practices, mind you, such as the aviation business that Stuart alluded to, where clients were limited to distributing only, for example, $45,000 per annum to themselves, and they retained the rest of the profit in the company. Now, the whole premise behind that was to just bring them up to that sort of second tier tax bracket, keep them under or keep beneficiaries under, for example, HEX thresholds. And what it does is just creates a whole bunch of missed opportunities. And it's really frustrating because if you think about it, you've got a whole bunch of retained earnings in a company that is basically doing nothing, likely cascading Division 7A problems, and has a large asset protection risk. So if you think about the opportunity cost involved, if you were to actually distribute those funds over the years and invest those funds, what would that look like? Now, you've been sort of conditioned to just focus on the tax component. Oh, I'm only paying, 5 or 10 grand of tax personally and the rest is going in the company. That's all well and good. I'm only my tax rate's under 25%. That's all great in theory. But once you factor in the opportunity cost of that money, then you've actually just lost a whole bunch of wealth that you could have otherwise earned over the years. Now, we always talk about compounding returns. So if you think about all those years of profits where you've only paid yourself that $45,000 a year and not invested in property or the share market or anything where you're earning on conservatively 7 to 10% annually compounded, then you've just cost yourself a whole bunch of money for your retirement. So sure, we spoke about what could go wrong. What's the right or what should be the proper approach to drawing out capital?
Well, of course, it's going to be different for every business and everyone's personal circumstances. And it really depends on the type of business you've got, what your personal goals are. There's, a variety of considerations here for us to really think about. But what Mena and I thought we would do is just talk about sort of a couple of the buckets that you could think about, in terms of how you're going to utilize your profit over the next 12 months and beyond. But of course, it's going to depend on everyone's situation. So the first step is really about living expenses. And, the key risk here is what I call lifestyle inflation. That if you have a really great quarter or a really great month, all of a sudden you're going out to restaurants every night. Now that sounds fun, and to me it really does actually sound fun. But the reality is that, you want to be able to measure that and manage that, and to a large extent avoid that as much as possible, or at least make it more of a deliberate decision, not a decision that is, dependent on, what happens in your business from month to month. So typically our advice, and nothing over is obviously in these podcasts is ever advice, it's information only, but typically our approach is that if we have a client that is below the payroll tax threshold, typically we'd like them to pay themselves a salary during the year. And that salary they pay themselves ideally should equal their living expenses and commitments. And the benefit of doing that is, of course, as you realize, when you put money through payroll, you've got to make PAYG installments, so you're paying the tax liability along the way. You're also forced to make super contributions, which I know is a double-edged sword. Okay, it's an additional expense for the business, but also it's a forced savings program for the individuals involved. So that's kind of good. If we've got a business that has a large wage bill, so they're already into payroll tax territory, we typically prefer them to take drawings throughout the year. But the best thing to do is make those drawings look like a salary. So that is, make sure that they're as regular and as timely as a salary. So in that situation, we might be transferring, I don't know, $10,000 a fortnight to ourselves, and using those monies for our personal commitments. But make it regular, pay yourself first, and then you can realize kind of what's left over after paying for living expenses. Can you allocate to those other buckets? Which is a good segue, Mena. Let's talk about buffers.
Buffers are good because they reduce anxiety, but I'm very conscious about talking about how much of a buffer really needs, because every business is quite different in terms of its cash flow needs. So for example, some businesses might live off sort of 7-day debtor terms and 30-day supplier terms, for example, whereas other businesses might be the other way around. Their suppliers or customers pay in 30 days and they've got to pay their suppliers within 7 days. So this really affects obviously the cash conversion cycle. So typically we advise clients to actually have a working capital buffer of about 3 to 6 months of operating expenses. Now, for some businesses, that might be a lot, and for some businesses, like I mentioned, it might not be enough. So it's really important to speak to your holistic accountant about what is a working capital buffer for your particular business. Then have a tax reserve account. So an account that you've put in place to basically put all your tax provisions in. So this would include things such as PAYG, GST, income tax, payroll tax. We've also had clients put in things such as provisions for annual leave, sick leave, long service leave, and work cover and the like. And it's really important to have these provisions so that if you do have a long-standing member, for example, that leaves your business, that you're not struggling to find the cash to actually pay them out. And then have a personal cash buffer as well. So a predictable surplus that helps you absorb any volatility in the business as it arises. So then we move to growth capital, Stuart, and I think this is your forte.
That's right, Mina, and we're really referring to reinvesting profits back into your business. And I think it's one of the common mistakes that business owners make, particularly owners that, have held a business for a long period of time. They just think, well, I don't know if they think actually, if they consider, whether putting the money back into their business makes sense. But at the end of the day, it's an investment decision. And the decision is, do you fund that investment through cash or through debt, or some other way, or even just through working capital in future cash flow? So the first thing you got to think about, whether you're buying a business, some equipment, another premises, whatever that looks like in terms of the investment, you've got to understand what the return on investment you're going to achieve. Now, it could reduce the business's risk. So for example, if you're a dentist and you run a dental practice and your practice location has a lot of goodwill, so it's been in that location on that busy corner of a main road for 30 years and everyone knows it's there could be a justifiable reason that you want to then own that premises and lock up that location. But the key thing is, you've got to ask yourself, where is the return on investment? Does it improve margin, for example? So it could be another bit of equipment that's going to actually improve productivity, reduce wastage, and as a result, increase gross margin. But it's about assessing that. Now, if you don't, and I find a lot of people don't, a lot of business owners others don't, their knee-jerk reaction is, okay, well, we've got the cash in the bank, we're just going to go and buy that thing. That's okay, but the problem is that what happens one day, 20 years down the track, 10 years, 5 years, whatever it might be, you decide, oh, hang on, I think I might want to retire. Now, and what happens if, it's a hard business to sell, or it's not ready for sale yet, or it's going to take 5 to 10 years to get it ready for sale? The problem is you've got all your equity locked up in that business because you haven't been in a situation where you've taken some of those profits out and invested in a way that's not linked to your business. So just be careful. I'm going to contradict myself here because I opened today's episode by talking about businesses that have a lot of cash and low gearing, but some gearing is typically efficient to build in, particularly if it's a large business and it's been around for a long period of time. So I would encourage owners to really critically think, where am I going to get the best bang for my buck? Do I invest this $500,000 into my business, or should I put the $500,000 into an investment property or the share market? And it's got to stand on its own 2 feet from an investment decision, which is a great segue, Mena, because we build a business typically for many different reasons, but to secure some sort of financial independence typically is close to the top of the list. And we can't do that unless we've got a pool of assets separate to the business that we can rely upon.
So I get to talk about the fun stuff, really. So that's really around sort of external investing and lifestyle, which I alluded to before. So once you have your buffers and reinvestment sort of metrics or figures in place, then you've got an amount that you can then allocate to investments outside your business. Now, we always say that your biggest sort of asset is generally your business. So it's really important to diversify away from it. It's really important to basically allocate funds that should anything happen to your business, that you still protect that you've still got a net worth outside of your business. So we always encourage clients to have an investable surplus that they allocate on a monthly basis that they can give to their advisor to invest on their behalf. So this could include things such as equities or property as an example. And then it's really important to then avoid the lifestyle creep that Stuart alluded to before. Now, it's only natural that as we earn more money that we want to spend more on ourselves and enjoy our hard-earned fruits. And there's nothing wrong with that. But it's also important to live within the means and the metrics of the buckets that we put in place before. So if there's a certain amount that's left over after investing or your monthly investing and diversifying and reinvesting in the business and the taxes and so forth, then it's okay to enjoy the lifestyle creep as long as you've got those buffers in place. So what does a capital allocation policy look like, Stuart?
So, Mena, it starts with living expenses. Of course, that's you obviously need to live. You've got to pay your own bills and so forth. So, you need to work out what your expected profit will be over the next month, quarter, year. And certainly as a priority, carve off those living expenses. As I said, whether you pay them as a salary or take regular drawings, you need to put that in tow. The second thing is then or priority, I should say, is to think about buffers. What level of buffer is adequate for your business? Are you there? If not, then maybe you need to allocate some of that monthly surplus cash flow towards building out that buffer. The next priority, in my view, is personal investing. So investing outside the business. And I say that because there's always going to be something to spend your money on inside your business. And the true success for building wealth comes from having a disciplined, regular process. So whether that's, making additional super contributions, investing in the share market, if there's a certain amount of your profit, whether it's 10, 20, 30% that you can allocate towards personal investment, I think that's a great idea. And then it's about what's left over and whether your business needs any investment over the next period of time, 12-month period or whatever it might be, and considering that. If not, then you've got to come up with a distribution strategy and make sure you carve off whatever additional tax might be triggered through those distributions. The key elements here are being able to accurately measure or predict what future profitability and cash flow looks like over the coming 12 months, have some clear allocation rules, as Mena says, to prevent that lifestyle creep, and review it quarterly just to make sure you're on track, to make sure it's heading where you expect it, and to course correct where necessary. Okay, that's it for us for this week. Until next week, bye for now.